Very strong. Small cap index is up even better, 1.2%. The mid cap index is up about 1% or so as well. So this is the overall picture on the indices which are starting up. Right out of the gates, I mean, it's everything up. Some 8 is to, not 8 actually, some 15 is to 1 kind of advances decline ratio. But this is just the first 30-40 seconds that we're looking at. Heat map on your screen in a bit should give you a sense. I think it should be all up kind of a day. We'll just have a look at that. Okay, you've got 2 names down. One is the oil producer, the other is NTPC. But apart from that, 48 out of the 50 names starting the day in the green. And we are past that 25,222 level, which is the first resistance for the market. Let's see if you're able to hold on to these gains. Subi.
Yeah, it's an all-green kind of a day. Take a dart, throw it anywhere. It'll land on the green side of the board, that sort of a day. In terms of sectors, by the way, PSU banks are having a very good start. PSU banks and PSUs in general, UCO Bank, Aircon, Union Bank, lots and lots of those stocks on the upside. And of course, there are the PSU oil refiners, HPCL, IOC, and BPCL. Nigel was alerting us about them in the morning. And indeed, they're up between 3 and 4%. So PSU pack is looking good. On the Nifty, everything is up, but the biggest gains coming in for Adani Ports, 4.5% up on that stock. There's Shriram Finance, about 3% up. Geo Finance, Adani Enterprises also. There's Ultratech Cement, it's M&M, JSW Steel, I mean, you name it. It's just a long list of winners. IT is also fairly strong this morning. TCS, Wipro, these stocks are up between 1 to 1.5%. You've got Reliance up about 1%, SBI, HDFC Bank, ICICI Bank, all 1% gainers, looking really good. The only stock that's down, obviously ONGC is not a surprise, down about 2%. NTPC is down 2.7%. We'll just look a little deeper into this and see if there's any particular reason. About 3% lower on NTPC, making it the biggest loser right now on the Nifty. But otherwise, solid looking screen. 260 points higher on the Nifty, Nigel.
Well, that's right. From the broader markets, a few more stocks just to highlight. Enviro Infra Engineers, that stock is in focus. They've secured projects worth around 300 crores in Chhattisgarh. So that explains why Enviro Infra is higher in today's trading session. Idea Forge had a good close to trade yesterday. The stock, I think, has more than doubled from the recent lows. Today, as well as opening on high volume. So Idea Forge as well as higher. Let's pull both those two up. Enviro Infra as well as Idea Forge. Both of them should come up for you on the screen. You have Bagel Projects, that's won an order yesterday. I think we have the management schedule later today. That stock, in fact, is up and about in today's trading session. So solid up move is what we're seeing on that particular name. And the other one is Avalon. Nimesh alerted that could be a large trade. I think that large trade has taken place, on that particular name. So Avalon as well is a little bit low, but that's courtesy the large trade that we've seen. KPIT Technologies, commentary a little bit skittish. The street is taking no note of that. The stock we're talking about is Avalon. So pull up Avalon. KPIT is lower as well because of the skittish commentary. But all in all, a solid start to trade. We hope that we end closer to these levels. The crude sensitives, well, they are on fire. OMC is up and about. BPCL, HPCL, IOC, all up between 3 to around 5%.
All right, we've got the market holding on so far. 250 odd points in the 250 odd points higher is what you have. I mean, the other one is Indigo, which is up about 3.5%. By the way, Indigo is the largest volume-led gainer right now. So it's a pretty straightforward kind of screen. Adani Ports, interestingly, is the other one, right? I mean, they've got, that port in Israel, which they operate. So that's up about 4% as well. I mean, the oil stocks, of course, are there. What else? I mean, Page Industries is up 3.5%. Mangalam was talking about Page. Hitachi is up 3%. Union Bank is up 3%. JM Financial is up about 5%. And you go down the list, Aarti is up 4, PG Electroplast is up 3. Lots of stuff coming through. And this is early on, in the first couple of minutes of trade. K Fintech is up about 2.5%. So lots and lots of movers at this point in time. And of course, it's predominantly on the upside, nothing very much on the downside at all. I mean, some reversal. So I was talking about defense, right? I mean, if defense should go up as conflicts rise, they should perhaps cool off a little bit as conflicts abate. Cochin is down 1, Garden Reach is down 3.5, HAL is down 1.5, Mazgaon is down 1.7, BEML is down 2.5, Bharat Dynamics is down about 2.5%. So if you look at the defense names, they're all kind of seeing a little bit of profit booking, nothing very much. I mean, they've all been such big winners. MRPL and CPCL, Chennai Petro, were both up between 7 and 10% yesterday. I think they're also cooling it a little bit, apart from the straightforward oil producers like ONGC and Oil India, which are down 2.5% and 3.5% respectively as well. So, as I said, it's a thematic kind of a day, but there is a broad lift coming through as well. 25, 240 is where we're at. Shreyash Devalkar is with us of Axis Mutual Fund. Shreyash, good morning. Great to have you back on the program with us. Appreciate it. Let's just hope now that the ceasefire stands and it's a bit of a clearing event for markets, and we can look at other things now. So, what are the other things which the market is going to focus on? Does the market need to readjust at all, or this 200, 250 odd point move that we have today? That's it. We didn't see any large risk off on the back of the conflict in the first place to begin with. What's your sense?
Yeah, so that Raj risk off was definitely was not there in the market. And in that context, definitely when it comes to, it's internal sector rotations. So we have seen some correction actually a little bit correction in the stocks which are crude oil price sensitive. And those stocks actually have seen some reversal after that. At the same time, overall, from here on, if we want to look at what next, then definitely this overhang of geopolitical issue, whether with this development, whether it is over, and we should move on with the domestic as well as other export-oriented parameters. So if we try to move on with that, few parameters are there. Definitely, we have seen rate cuts. We are seeing now crude oil prices coming down, and its impact on overall credit growth. So what one should look forward to is with cut in the CRR, the cut in the repo rate, and improving liquidity, how the credit growth will shape up from here on. Because there are 2-3 elements which are in their favor. One is liquidity. Second is now the ECB. Actually, versus ECB, the domestic loans are actually much better, and that should give some kicker to the credit growth. And lastly, the retail credit growth may actually come back. So with this, I would actually look forward to that piece on an overall macro front, when and whether it is coming back and how soon it will come back with the festive season just few months away. So that is one part. On the exports front, there has been uncertainty because of tariff to these geopolitical situations. That overhang also is everyone is watching out for. In my opinion, if you look at IT, then in case of IT, that overhang need to come back, need to subside from here on. So that is the other place and where the valuations are reasonable. And thirdly, the other space where the valuations are reasonable is auto. So I'm just highlighting the spaces where the valuation compared to pre-COVID are reasonable, which is banking, there is lending, then there is auto, and then there is IT. So in these spaces, if there is some chance of growth to come back, then market should look forward to it.
Okay, IT and auto, these are some pockets you're looking at. Got that, Shreyas. Good to have you on. That was what I was coming to, just to understand the broad house view where you're looking to place, new bets. We just had a discussion on IT, and I think it's still a debate out there because we're not getting the kind of growth numbers that the market would like to see. Large cap companies are still giving you anemic growth, mid-single digits, not even seen high single digits in a while. And mid-cap companies, they're not all moving together as a basket. Some are up, some are struggling. Can you just expand on that point on IT? How do you find valuations and why are you willing to look at it?
Valuations-wise, definitely one comment I might have made earlier on this show that yes, this sector has, despite slowdown, this sector has not got derated. So the first decade of this century, the growth was 15% and the multiple was 20-25. Second decade, the growth was 10% and the multiple was 15 to 20. And now the growth is around 5% and the multiple is around 20-22. So with this, as far as valuations are concerned, on the PE basis, definitely the valuations are not have not corrected commensurate to the growth slowdown. On the other hand, the cash flow profile of this sector has improved a lot compared to 2 decades ago, and that's where including the dividend and buyback that actually lends some support for the valuation, and especially in the context of every other sector which has got re-rated a lot. Now coming to the growth, so obviously without growth, nothing moves up in India, just because whatever metric of valuation we can use, it may be free cash flow yield or it may be PE basis. So on the growth front, that's what my point was, that yes, with the global uncertainty. So the global uncertainty is leading to the indecision. And that indecision first started with the tariff uncertainty and now with the geopolitical issues. So on both these front, I think the tariffs and the negotiations are on, and probably we are at the fag end of it. So that is one. And secondly, on the geopolitical situations, if this subside further. So in this both these situations, if the sector, the growth for the sector improves, then there is a chance. Now, as you're rightly highlighting, the large versus mid and small. So the large cap, actually recently there was a result of Accenture as well. The large cap is seeing some pressure on overall growth for some time, and that's where the opportunities are to be found out at in the multiple sub segments of IT. It can be in the niche segments. The companies which are focusing on the niche segments in this, and some companies are there in the products as well, and some companies are there in engineering R&D. So it need not be the traditional way of investing, wherein the growth would depend more on the revival of the global outlook. But at the same time, there are pockets where there can be growth.
Hi, Shreyas. Good morning and good to see you, Ben. What about travel and tourism? You're quite bullish, I think, on the prospects out there. How do you play this theme, though? You have hotels, you have, the one listed, quality aviation stock. What's the view out there? How do you play this entire travel and tourism theme? Hotels, what else?
So in travel and tourism, there are multiple aspects. Definitely, see, this sector now is a discovered and established sector. So actually, so is most part of the market where there is a, so to say, structural growth in last 2-3 years. And those, this is hotel and basically tourism is one of them, like EMS services and manufacturing. So hotel tourism is one of them. This sector being already discovered, there are names obviously in the hotel space, they are in airline, or with airline there are not many options. Then you have certain companies which are derivatives. Some companies are there in the IT as well, who are focusing on the niche areas of tourism. There are players also in the luggage segment, but then their growth has been patchy. But then market should look into it when the growth comes back in that segment. So in all segments, actually, the what market is focusing on is the segment where there is a consolidation and there is a few winners, few clear-cut winners, which are emerging without much incremental competition. And that's what you are noticing, that market has flocked to those. While there are certain segments where there is a competition. Now, the luggage segment, there is a competition. Newer brands are coming. And in that context, though the sector is doing well, the companies may not have done well the way you wanted. And that's where it's a combination of both sector tailwind and consolidation in the sector, and you being with the winner.
Okay, all right, got that point. Overall on earnings, Shreyas, I mean, that's the big hope for the market, right? That eventually we'll get a revival. FY25 was an aberration. What would you say? 10 to 12%, more than that, less than that? What do you expect on the earnings revival front?
Earning actually FY26 already, in my opinion, the earning cuts have happened because earning cuts were there for last 2 quarters now, 2 to 3 quarters since September quarter, especially it started big time. And with these earning cuts, which we have already seen, in my judgment, FY26 earnings probably may not see further cuts because all the issues which we market knows, which is the NIM impact on the banking sector, which is high weight and which actually drives the earning for the Nifty 50 or any large cap index. So in that context, most of this news and earning cut for FY26 is there out there in the market, and in my opinion, it may not get further cut. FY27, obviously, that earning scenario has to emerge from here on, and in that probability is there. Yes, you may see some earning cut on FY27, but FY26, I think it's probably there.
Okay. All right, got it. Shreyas, good talking to you this morning. Thank you very much for joining in and giving us perspective on the market. The market continues to chug along quite well. Actually, before we move on to our next guest, quick stock, 25,200, right at the top of our recent trading range. And this is a range that's been on for a good month now. And we're right at the top of it. So let's see, 1% higher, looking good today on that screen. The next sector that we're putting the spotlight on is actually the hospitals in the healthcare space. Now, we had big news come in over the weekend. Amazon has announced its entry into the sector with the launch of an at-home diagnostic service. PB Fintech, of course, we know, is going to be investing close to 700 crore rupees in its healthcare arm. They're looking at building their own standalone hospitals, and maybe the first of those hospitals would be completed by the end of this year. Let's discuss these developments and what it means for the sector, for patients, for the incumbent players. We have the management of Narayana Healthcare now joining in. Narayana itself is looking to offer integrated healthcare services across the board as well. We have with us Sandhya J, Group Chief Financial Officer at Narayana Health. Sandhya, always a pleasure to welcome you on our shows. And like I said, I mean, it was a slightly long preamble, but just to put things in context, because there's a lot changing. You yourself are looking at clinics, you're looking at insurance, you're looking at a far more integrated healthcare offering. So what does this changing landscape really mean for competition, for patient services? Opening thoughts.
Good morning. Thank you for having me here. So if you look at Narayana's mission and what we've been trying to solve from the day we started, we've been trying to solve for accessibility, affordability, and availability. And that is really the goal of healthcare. So the more players that come into the market and with different perspectives. So for example, Amazon comes with a very heavy tech-enabled service orientation, which is a positive movement to the market and so on and so forth. So we do believe that these are positive developments to the sector. Coming closer home, I think as regards to our own integrated care journey, we believe that we should take responsibility to keep our customers healthy and not treat them when they're sick. And that's the premise in which our entire integrated care business has been built. And we are hoping that we are able to create that value to our customers.
Sandhya, can you give us some more numbers with respect to your own foray? Before we talk about, the entry of other players like PB and Amazon, just, set the stage for us in terms of the clinic program that you have, the launch of clinics. How much money are you putting to work? When will this business be profitable? And similarly, insurance. What exactly are your plans and what are the targets there?
Sure. So we have already launched more than 10 clinics in Bangalore. We have about 4,000 people, lives insured in our insurance plan. We don't look at these as separate developments. We look at them as a holistic way by which we offer care. So which means that the clinics work closer to where people live and therefore more routine care for people. And when they are in need of coming to the hospital, the insurance operates like a financial enablement. So that's really the model. The other part that we are trying to solve with the insurance business is we are trying to solve for the missing middle, which is people who don't have access to many public healthcare who cannot afford insurance today. So it's a low cost, no frills insurance. So that's the other segment that we are targeting for. from an investment point of view, we've committed 400 crores in this business over the next 3 to 4 years. Our break-even will be cohort by cohort. Like, for example, the first set of clinics that we established, the first cohort of clinics, they've completed 18 months and they've already broken even. The second set of cohorts are now going through that journey. So it's a cohort by cohort model. The same thing with insurance. We would take insurance into a particular city. So right now, for example, we've launched insurance in Bangalore and then we're
got that.
in Calcutta. So we're looking at a 2-3 year break-even period on a city-to-city basis.
Right. Got that. And good to get those plans across as well. Sandhya, good morning. Prashant here. Now, let's just talk about Amazon Diagnostics, right? Is it going to be a threat to players like you, to other players in the system? It's a tech giant. They're promising fast turnaround reports. I mean, routine test results within 6 hours. The reports to be found on the Amazon app. Of course, they'll do what they can. But as things stand right now, with the information we know, do you think there will be a threat?
I cannot comment for other players, but for us, we don't see them as a threat because we've always said that diagnostics is very important. Preventive is very important. A lot of the healthcare that people are availing today is because they did not attend to themselves on time. And growth of a diagnostic business only enables people to manage their healthcare better. It will definitely motivate players to invest in tech and be more customer focused, which is where the industry has to progress. For example, if you take Narayana, most of our reports are delivered in less than 60 minutes on the app. And it's a total digital experience. So we've already cracked that model inside Narayana. And it will probably motivate us to do more and more of that so that we are able to match up to the how the demand is being consumed.
In a way, do you expect them to act as an aggregator, Sandhya? Amazon, their entry as you see it?
See, I cannot comment for their strategy, and they always try to pivot along multiple axes. So I'm guessing that they may want to look at aggregation as an axis as well, but I don't think it's my place to comment on that.
All right. Hi, Sandhya. Good to hear your thoughts. Well, on integrated care, you mentioned a couple of times. I think last year the cash burn was close to 65 crores. Do you see this coming down this year? And just want to revisit the break-even timeline for that.
So we've committed about 400 crores over 4 years for the integrated care business, which is insurance plus clinics. We will burn cash in the integrated care business. That's because we're opening more clinics. So at a cohort by cohort level, we are breaking even. So this year, we will not reduce the cash burn. It will increase. But our first set of clinics have already broken even. And we will continue that cycle.
Yes. Got it. Okay. All right. Specifically on the insurance part of the business, which is also part of integrated care, as you said, could you give us some more color? You'll have launched a new product. I think it's Arya in 2025. So if you could, give us some kind of number, some kind of guidance, premium growth you're targeting, number of policies you're looking at in FY26?
So we haven't publicly disclosed the numbers that we are targeting, but we are looking to grow in the focus markets, which is Kolkata and Bangalore in FY26. So these are the key markets. And of course, there are other markets that we will expand into. We are already present in Mysore. Now, the model is that it's an integrated experience. So we start with a proper intervention in terms of what are the health needs of the individual, and then we build on the journey along with that. So it's not like when you fall sick, we'll pay for you, but we will manage your health. So that as a concept is taking some time for people to understand and latch on to. So there has been a slow progress, but this is the model we want to build. So we are fully committed to growing this business. So we will be able to share more numbers as we start building out.
Sandhya, so just to understand this insurance piece further, you're a hospital chain now looking to offer insurance solutions. PB Fintech was an insurance aggregator platform, and now they're looking to set up hospitals, get a separate company going with separate set of investors. So we're just trying to understand how this really works out and what's the end game for you. Of course, better solutions to the customer are well taken. I'm just trying to understand from a business perspective, how will this be priced? What is the scale-up that you have in mind? And what will it mean for you in terms of profitability margins? Just explain the business in this.
For integrated care?
Specifically for the insurance business that you're setting up. Not clinics, just insurance.
Okay. So our insurance business model is similar to other insurance providers. The only difference being that it has a lot of preventive components inbuilt into it. So, and we are also, because we work very proactively regarding the health outcomes, so we also have access to a lot of data, because of which we are able to proactively manage the health requirements. So the way we have priced our insurance product, number one, it factors the element of trust. And we have spoken about the ecosystem of trust, and I don't want to repeat it. That helps us bring the costs down. The second part is that because we are proactively intervening, therefore the cost of care also goes down. So that is priced in, and that benefit is passed on to the customer. So that's our financial model. So just give an example, Aditi is a policy which is priced at about 1,000 rupees per month approximately for a family of 4 for a 1 crore coverage. Now, it just looks like a lot. That kind of policy doesn't exist. But the reason we are able to do it is because the care is managed completely inside our network, and it is managed in a proactive way. So that helps us build the cost, bring down the cost. And that helps more people who don't access insurance today access insurance. So that's really the theme with which we are building this.
Sandhya, we'll leave it there. Thank you very much for joining us. Good speaking with you, and good luck. It's done very, very well. The business and, of course, the stock as well. That's Narayana Health for you. But, I mean, in terms of Amazon Diagnostics, as Narayana looks at it, not a threat, at least not at this stage, more tech-enabled sort of online aggregator at this point in time. We'll take a quick commercial break here. We're going to come back with an interesting conversation with a new IPO, which is coming up. A well-known brand, especially here in Mumbai, Kalpataru. The management is with us here in our studio, so going across to them after this quick break.
Well, Mumbai-based real estate developer Kalpataru is going to be raising around 1,590 crore rupees, and the subscription for the IPO opens today. Do you know the company will utilize close to around 1,200 crores for debt repayment and other general purposes as well. Joining us on the show today, we have Mr. Parag Munut, the managing director, and Mr. Chandrasekhar Golekar, the chief financial officer at Kalpataru. Good morning, gentlemen. Thanks a lot for coming down to the studio. I was just looking at the anchor book, and some solid names have featured out there. So good on you all. That appears there's a fair bit of interest, and I think we should pull up some of those names on the screen. That said, this is going to be a fresh issue. So all the money comes back, and primarily it's going to be used for debt repayment. As I mentioned earlier, around 1,200 crores of that will be used for debt repayment. So a couple of details. What is the interest cost savings on this 1,200 crores? That was what were you borrowing at, point number one. Point number two, the debt number, if you could update us, post this 1,200 crores, what does it come down to?
Thank you, CNBC. So we are quite pleased. I mean, it's the first day. I mean, issue opens today, and This is really good to have us on CNBC. Thank you very much.
Appreciate it.
So the issue is of 1590 crores, as we know, and precisely 1192 crores is the debt repayment. All of it is going to the financial institutions and bank, which will reduce yearly interest. Minimum reduction will be around 100 to 120 crores or so. So far as the debt equity ratio and everything, because today the net debt in the books as of December, which is the reported accounts in the financials, is around 11,000 crores. From there, if we reduce the promoter CCDs, which then later got converted into equity in the month of March, just 3 months ago, and the cash and bank balances, what remains is 9,200 crores. So from 9,200 crores, it will come down to 8,000 odd crores because of this 1,200 crores repayment. And the equity, because of the conversion of CCDs, I mean the conversion happened at 1,440 crores worth of conversion. Therefore, the equity rose to 2,500 or so. December was around 1,500, then 940 crores got converted. So 2,500. And that further will increase to 4,000 because of the 1,600 issue.
Yes.
So post issue, it will be therefore just below 2 or so.
So it comes down to ballpark around 8,000 crores. Got that?
Roughly.
Got that number. Are there further plans? Because this is something that could be plaguing investors with regard to the debt on the books. You have explained that you're sounding pretty confident as well. Are there any other plans to reduce debt? Maybe some land parcel monetization, internal cash flows as well will come about. So just on this debt part, are there plans to reduce it further?
So yes, absolutely. So organically, the real estate debt, we need to understand how the real estate sector works. So in real estate, it's a capital intensive sector. More so if it is in MMR Mumbai, where prices are as such high.
Yeah.
So in the initial years of the project of 1 to 2 years, maximum 2.5 years, the capital is provided in two forms. One is equity, another is debt. So debt is an ingredient part of this whole mechanics. Now, when the debt is utilized for the underlying projects which are throwing cash flows, which we typically call it as ongoing projects, which we have 2.5 crore square feet, out of which we will be actually delivering around 1 crore square feet, 11 projects in FY26 and FY27 together. They are going to throw handsome cash flows, net operating cash flows, because almost all of the land cost is fully paid already in past. And that represents actually part of the debt, frankly.
So the cost has been taken up front and the revenues will come. So let's just start from a little bit of basics. Gentlemen, thanks for coming in. Parag, if I can come to you. Tell us a little bit about the, the business per se. This is, for our viewers who don't know, it's a well-known brand, and very visible around the city. But just tell us a little bit, what segment are you in? How much, I think, Mr. Jogelkar mentioned some land parcels, etc. How much developable area you have? Just the basics. Give us a sense of the size of the business.
Thank you, Prashant. Thank you, CNBC. Yeah, we are a 55-year-old brand, so we have been in the business for 55 years. Started from Mumbai. We have been in the whole region. We are one of the only developers who have been across all the 7 micro markets of Mumbai. So starts from Altamont Road, Carmichael Road, all the way up to Mira Road or Thana. We've been in Thana for about 30 years. We've worked in Panvel and all. So we have a deep insight onto the market. At this moment, and Pune, we do Pune. We are Pune for 30 years. At this moment, we have about 50 million square feet. That's about 5 crore square feet of projects which are broken up into ongoing, which is about 25 million square feet, 2.5 crore. Ongoing means they're going across every micro market. These are in 25 projects. And the forthcoming is which we launched in the last 6 months, because after we filed the DRHP, or in the next 18 to 24 months, we launch. That's about 16 million square feet. That's about 1.60 crore. And the balance, 5 projects, which comes to about 7.8 million, about 78 lakh square feet, is planned, which will get launched from 24 months to 36 months. Now, this 50 million square feet, as he said, it's out of that 75% is owned land. So we've paid all there's no litigation, nothing, all clearance are there. The balance is a JV, JD, and redevelopment. Redevelopment has become a strong thing in Mumbai. So we have some of them going on. We're doing redevelopment from 15 years. What we play across is play across from luxury, premium, aspirational. We have across the whole field, all spectrum. So we have a deep insight on what customers are wanting in each field. So case in point is our portfolio at this moment of projects, our inventory. 70% is sub 3 crores. That means Mira Road, Thane, Amulun. So we have that cycle. 10% is between 3 crores and 10 crores. And the balance 20% is 10 crores plus. So we know what customers want, customers demand. And
in terms of the business, Parag, just one thing. Is it, you said that, are you moving towards more JDs? And I mean, not acquiring land outright, I mean, more asset light. Is that the way forward? What's your sense?
For the near term, it is an asset-light model, as we have enough lands which we have bought. And because of the DCR regulation changes which has happened in Mumbai, the redevelopment has got a lot of boost. It's making Mumbai younger. It's making with all the amenities and facilities within the Mumbai. Everybody has to have additional parking, amenities. So that, we are doing redevelopment from last 15, 20 years. So that will give us a lot of boost. So that will be the growth.
So, Mr. Manoj, actually I had a big picture question, but since you brought up redevelopment, let me take up this part first. Help us understand from an operational perspective and a margin perspective, how does a redevelopment project compare with, say, a project where, whether it's a JDA or whether it's, a project based on your own land? I'm just trying to understand the brass tacks of the business.
So in redevelopment, your investments are less because you're not buying the land. And especially in redevelopment, once all your approvals happens, then you tell the society to move out, then only your investment happens in the land.
So how much higher would the profitability or the margin, say, on such a development be?
So margin-wise, it would be about 25% and all that. When you own land, your margin would be higher because you get the capital appreciation also on the own land. Could go higher.
Okay, Mr. Joglekar, I think you want to just add a point. And the mix that you'll I mean, in the next immediate 1-2 years, what will the mix be? And what will that imply for margins?
So first of all, today we are 75-25, as Mr. Parag mentioned. So that will generally continue for 2 years because, we will add more properties, but that will take time to come into the launch, etc. So far as margins are concerned, he is absolutely right. Initial capital investment in the redevelopments and joint development is very, compared to the greenfield land acquisition, it is quite low, number one. And greenfield land acquisition takes little more time to develop because we have to go through the title, the approvals and everything. Therefore, the land appreciation, whatever rate we get, that is why the margins there are higher than the redevelopment. And because in redevelopment, once we execute definitive documents, we have to immediately
and you have to hand over the project.
So the time gap is not much.
Okay, so Mr. Manoj, now I'm coming to the bigger picture question. The Indian real estate space is going through a lot, right? Largely family held, but now it's getting corporatized, from the Oberois to Macrotech to so many companies have come to the market. Now you're coming in. A lot of companies are also having pan-India aspirations. I mean, look at the Bangalore boys, Prestige and all of them coming into Mumbai. How intense is the competition in the Mumbai market for you? And will you also think of going out of Mumbai, Pune, this zone anytime soon?
Sure, good question. There were top 7 cities of Mumbai. Out of that, the sales happen in 50% of sales happens in MMR region, Mumbai Metropolitan Region, and Pune. The launches and sales. So this is the biggest market in a way. In that, we being there for so many years, we have a deep loyalty, reputation, customer experience. So we don't feel the competition to be so much. We definitely will go out. We have one project in Hyderabad. Hyderabad is a deep market. It's a growing market. We completed, it got good sales. The first phase completed, second phase 60% sold out. We look at there. We finished one project in Noida, fully sold out, did well. So there is, but at this moment, because of great opportunities in the MMR and with the infrastructure boost finally coming in MMR in the last 10 years has really made a very attractive market.
Just one question, Parag, on the timing of the issue itself. Any thoughts? Why now?
Why now? Maybe we should have done it earlier. But we thought...
Because we've had a very strong last few years of real estate, right? I mean, so you could have gotten in early, or you're coming in, I don't know, I mean, any thoughts on the timing?
So we have another listed company, so we know the play of listed company. We realized that we should come when we have the right amount of projects and we have a right runway for the next 4-5 years. And we were all there. So all these 25 projects and the other projects, we got them all ripe up. And that's the reason.
And for the industry, which year in the cycle are we in? Normally in the 10-year cycle? It's going to be interesting because your IPO is open today.
Middle of the cycle, early part of the cycle, where are we?
Some clues. from the analysts and all the analyst agencies which they do, we have average inventory of 16, 17 months in MMR.
Okay.
Ready to move in inventory is almost negligible. When these are the two parameters, we should always keep watch on this. That means that that geography where, I mean, what this data relates to is not picked up.
Okay, all right.
Okay.
That is point number
17
one.
months, okay.
Which was earlier 35 months,
Okay.
3 years back.
And just to add to what Parag said, is that why now? So as the projects, we launched 1 crore square foot of projects in last 3 years. And we are completing 1 crore square feet of projects in next 2 years. I mean, 26 and 27. And secondly, promoters have infused 1,440 crore, almost equal to the size of IPO, just less than that. In March, in form of equity in the company at 517 rupees per share. So for the viewers to note, promoters have infused 517 rupees per share and the issue is being offered at 414 rupees, I mean, at a higher band.
That's how you must have gotten, right? GIC Singapore, Bain Capital, SBI Mutual Fund, SBI General Insurance. I'm sure that had something to do with convincing those marquee investors to come on board.
Well, thank you very much, gentlemen. Good luck with the issue. And I think this will be the first of many interactions over the coming quarters, years. Thanks very much, Parag.
Thank you. Thank you, Prashant. Thank you, Surabhi. Thank you, Nigel. Appreciate. Yeah.
Okay, well, that is the Kalpa through real estate business, which is coming to the market. So watch out. Well, I just move on now, and we are now joined by Nikhil Bhandari, a co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs. Nikhil, thanks for waiting. Good morning. Appreciate your time here on CNBC-TV18. I'm looking at the title of your report, The Great India Energy Climb. So with, let me ask you, let me throw it open to you. Just the top 2 or 3 takeaways from what the main points that you're making through this report, Nikhil. You tell us.
Yes, absolutely. Thank you. Thank you guys for having me on the show. Now, look, the main anchor punchline is that we are seeing a structural shift in India's power and the energy demand. We now expect the power demand to grow at over 7% per year through FY35. Now, that's a significantly faster run rate than what we previously expected. The important thing is this isn't just driven by data center, AI, or EV charging, which is the theme of the West for the power demand growth. What's really driving this is the income growth. As more households move up the ladder, they buy more air conditioner, washing machine appliances. So that's driving the growth. The big push towards the manufacturing is driving the industrial power demand growth. So again, we're not upgrading our GDP forecast. We're just upgrading our power consumption intensity to GDP forecast, leading to this punchy power demand forecast number. Now, the other thing that we have done in the report is we have looked at the supply side. Where are the likely bottlenecks in supplying this demand growth? The first one we've talked about is the potential ceiling for the growth in the renewable capacity. After a huge runway of growth in the last 10 years, we have some technical constraints around ramping up renewable at a similar pace for the next 5 to 10 years. So we talk about the bottlenecks there and what's needed to break the bottleneck, which is the battery storage. We also talk about more thermal capacity still needed to avoid a potential energy deficit, which could be as much as 9% by FY35 if we go with just the current pipeline or the current target of the thermal capacity addition of the power system. And the last bit is the bottleneck is the distribution electrification. We've done a great job electrifying our generation, transmission infrastructure, but distribution, the last mile, still needs to be electrified. And our transmission and distribution losses are still high at 18% versus the world average below 10. Now that sets up the investment themes because investors need to own the bottleneck in order to create alpha from a stock market perspective.
So across these 3 themes, Nikhil, talk to us about how to play on the equity side. Just take us through one by one.
Yeah, sure, absolutely. Look, we can't specifically talk about the stocks, but I'll put the framework here. So the opportunity clearly for investors is to own the bottlenecks directly. The first is on the renewable side. The bottleneck on the renewable side is not the solar cell or solar module manufacturing anymore. We're already in overcapacity for modules. In a year or two, we'll be in overcapacity for solar cells as well. Our demand constraint, our demand size is going to be more limited. We are already growing 25 gigs solar per year. We can get to the run rate of 30, 35. But if we keep doing that for another 2 to 3 years, we have a theoretical limit on the coal, because you need a larger base load. And in order to, when you're 45% of the capacity mix is solar during in your total power capacity, we have to flex down coal during the morning time when sun is shining, and there is a theoretical limits around it. So that defines the demand for me. If demand is growing 30, 35 gigs a year, we have more than enough solar modules and cell capacity coming online. The real bottlenecks here are the polysilicon, the batteries, and somebody who can take polysilicon all the way to create into module and power out of it. We think that is the business model which is eventually going to survive. So that is one. The second is who's going to help us create more thermal power generation, given we have a 7% power demand CAGR, and we have some constraints in the growth in the renewable capacity after reaching this a huge size of 45% in the capacity mix. So thermal generation is another bottleneck. And third is the distribution. It can be played through either the equipment side, because we need to electrify the last mile distribution. We need to put more smart meters, more low and medium voltage distribution lines. And for that, we also need the companies who can work on the ground and electrify the distribution and privatize the discom. So again, those are the main themes that we are focused on from a stock picking perspective.
Yeah, I know. We're regretting the fact that we can't get down to individual stock names or understand that you have limitations, Nikhil. But just talk to us at least about this. I mean, investors could look at an integrated player like NTPC that's doing everything from thermal to renewable to even nuclear they're getting into. Or maybe a Tata Power that's looking at both ends of the spectrum. Or you could try and target niche stocks and niche companies. For instance, I mean, mentioning offhand, there was this news item on NLC India. They're setting up a battery storage plant now in Tamil Nadu. So what should people look at niche pockets like the solar cell manufacturers or someone who's setting up, a battery storage system? Or are you just best off with integrated players for the next 1-2 years?
The our call is really to directly own the bottlenecks. And the bottlenecks, as I mentioned, are who can make the polysilicon, who can make the battery cell, not just the battery packs. Cell is the harder thing to do, not the packs. Packs is a low entry barrier business, but cells is really hard. Who can manufacture the cells? Who can really provide me the equipments for the last mile distribution electrification? And who can build the thermal generation for us? So again, to us, it's more about owning the bottlenecks directly, rather than we own every piece of the power value chain. Look, there has been a strong beta in the sector 1 to 2 years ago, and that's because we started seeing power deficit. And when the beta is there, typically the whole sector may do well. But in order to create alpha, we believe we need to own the bottlenecks directly. And these are the bottlenecks that I mentioned.
On thermal, I mean, while your point is well understood that there are certain constraints to ramp up on renewable, but this focus on thermal again, is it a short-term thing? I mean, for next 2-3 quarters? Or is it the next 2-3 years that we're talking that the focus will remain on thermal and therefore you're looking at, ways of playing that, coal, etc.?
Yeah, look, this is a 5 to 10 year view. Look, there is a discovery of thermal as an important part of India's energy mix still. If our power demand is growing 7% per year and renewable is intermittent in nature, and we don't have a lot of batteries manufacturing locally, I think thermal will still play an important role in the India's overall energy mix and the power mix, because we have to balance both the decarbonization, the environment, but at the same time, the growth that I talked about, the structural rise in the power and energy demand growth in India. So we have noticed clearly government did triple out the thermal coal plant addition target about 18 to 24 months ago. And they're looking at about 88 to 90 gigawatt of thermal coal plant addition by FY32. If we assume that comes as per plan with a couple of years of execution, timeline. In addition, we're still seeing about 9%, up to 9% energy deficit in the country by FY35 for certain weeks during FY35. Now, this is not just the non-solar hours evening deficit we are saying, we're talking about the energy deficit. So we need some more reliable round-the-clock solution beyond renewable. Now, what are the options we have? Beyond coal, we've got nuclear. Yes, that'll be an important solution, but nuclear takes longer than coal. So that's a 10-year and onward story, which will be an important part of the mix. But we have a problem heading into the next 5 or 10 years from an energy deficit perspective. We have another option is the gas-fired power plant, but the gas is the most expensive solution on the power cost curve in India. So again, India isn't really at this point building more gas-fired power plants. The third option is hydro. Again, we are going hydro aggressive, which is makes sense, but hydro plants also takes longer than thermal coal. So again, from the reliable round-the-clock solution beyond renewable, the thermal coal still is an important option for the India's power mix in order to meet this 7.2% CAGR in the power demand growth for the next 10 years.
Got that, Nikhil. Good conversation. Thank you very much for joining us, and really provides us with, a framework in terms of how to think about the plays around the growth and power demand through various angles. Thanks very much once again. As Nikhil Bhandari of Goldman Sachs with some perspective there. 240 points on the Nifty, 25,200, still holding very, very nicely. Mitesh is back with us with what he'd want you to do with specific trades. Mitesh, what do you have?
Yeah. So there's some good traction in auto stocks, and Ashok Leyland has just got into a positive setup. So buy here with a stop at about 237 for targets of around 250 to begin with, and then we'll look at higher levels. The other stock which I like, that's Bank of Baroda with a buy with a stop at about 235 for targets of 247.
Okay, all right, Mitesh, got that. Thank you very much. We will take a very quick break on that note. Come back on the other side. We'll have Manisha joining in with the latest update on the commodity world.
She didn't give good wishes, yeah. What did he
Clearance and title and all. Welcome back. So the equity markets are having a good morning. Still 230 points up on the Nifty. And that's actually thanks to the commodity markets because that collapse in oil prices, that has made the equity bulls quite happy today. So let's go back to Manisha. Manisha, what's the latest?
You know what, Surabhi, yesterday, same time, we were talking about on how the crude prices surged 5%. We're talking about almost an 11% of a decline if you count yesterday and the kind of declines that we are looking at today as well. So overnight, we've seen 8% of a cut coming in. Asia's open 4% on the lower side. We seem to be gaining a bit of that ground there. But in the last 1 month, now we're just about 9% on the higher side. And for 2025, overnight, we've turned negative for this year. We were trading up by nearly 8% yesterday when I was talking to you, and we're down by 7%. So all of that clearly has changed very, very quickly. Clearly, as we've been talking about, we are trading now at around 2-week lows when it comes for the crude oil prices. It's back at the levels before that Iran-Israel war began. Clearly, Trump announcing ceasefire agreement and the kind of statements after that we've seen from Iran and Israel coming in also seem to have taken off that premium that crude prices was holding for some time now. And then Iran's retaliatory strike that we saw in Qatar also not leading to any casualties and not too much of damage as well is what gave us sigh of relief. The oil prices also clearly have avoided that worst case scenario of Strait of Hormuz closure as well. And that was a premium that was building in for prices. Trump's statement telling everybody to keep an eye on crude oil prices, ensuring that it does not keep up. Everyone keep oil prices down. I'm watching is the statement or is the tweet that Trump put out yesterday seems to be working at this point in time. I also want to put out on what brokerages have been saying in case there was a de-escalation. Remember, we heard all of those statements from Bank of America to Citi to Mizo saying that the prices can go to 95, 120 as well if there is a worst-case scenario of Strait of Hormuz closing. But now we're talking about all of these groups talking about, now that you're talking about de-escalation, you could be looking at the crude prices coming off as well. So Mizo says that de-escalation can bring the prices down to 65. There are similar statements coming in from Bank of America, while they talk about 75 as an average for this year, which is where we already are. But they also talk about a range of anywhere between $60 to $80 until 2030 as well. Cities talked about 55 if we do not see if we do not see this escalation, and if there actually is an agreement between US and Iran, then the prices can come off quite sharply. 55, 50 are the kind of levels Cities spoken about, Bank of America has said, and Goldman Sachs talked about that as well. But moving forward from here, there's just so much to watch out for. To begin with, the Fed's rate cut plan for the month of July. We've seen a lot of statements come in from the Fed officials to this. And then you also have the 9th of July tariff deadline. It is going to be about the big, beautiful US tax bill passage as well. And then the street will absolutely watch out for the Jerome Powell's testimony for Congress today. Further cues would be coming in from this one.
Okay, all right. Thanks a lot for that quick update, Manisha. But let's get back to a couple of stocks that are moving around. And Vinny joins us to tell us about KPIT Technologies that's under some pressure. Vinny?
Hi, so yes, we have KPIT Tech that's in focus today. Why? Because they came out with their mid-quarter update. Now, when you look at this update, they're talking about the business environment being weak. There's uncertainty globally in terms of geopolitical tensions, overall tariff scenario. So that turns out to be a concern for the company. Deal pipeline. They're seeing strong deal pipelines, but the conversion of these deals, that's at a slower pace than expected. Demand trends in Europe is good, but US and Asia, that's where they're facing a bit of a problem. Ramp-ups for the wins that are progressing well, but that is also going at a slower pace. So most of the things are happening, but at a very slow pace. Now, they do not expect any one-time gains also supporting the profitability in Q1 FY26 versus Q4 FY25. So yes, a bit of an impact in terms of profitability over there. Forex also, the rates have seen a sharp change coming in. So that is also something that of an impact that we could see coming in Q1 FY26. Now, on the back of this, we have Kotak Institutional Equities that's written a note as well. They've given a sell rating target price of 1,000 rupees per share. They've cut the FY26 to FY28 earnings by 3 to 4%. JP Morgan has also written a note. Overweight rating is what they're maintaining, and target price is 1,500 rupees per share. They believe that Q1 could actually be a quarter of decline for the company, and then a bounce back maybe is something we could watch out for in Q2 FY26. They've cut the organic growth by 4% for FY26 and also cut the FY26 to FY28 CAGR growth from 16.5% to 14.5%. So yes, a bit of a pressure is what we're expecting to see in Q1 FY26, and that's why the stock is falling in trade today.
Okay, all right, Vinny, got it. Thanks very much. Explains that 5% drop on KPIT Tech today. We'll take a break, come back on the other side, and then we put the spotlight on something rather interesting, the rise of a global short drama market. We have Karan Taurani joining in. What is the short drama market? We're talking getting your attention in 90 seconds, literally. And what kind of disruption perhaps could it bring for incumbent media companies? Raj Nayak and Karan Taurani join in on this discussion. Welcome back. Well, time for some drama. And we're talking literally, actually, because we're putting the spotlight on the rise of the global short drama market. Now, what is a micro drama or a short drama? These are very, very short, bite-sized video stories which seem to be rapidly gaining attention of viewers, and they're garnering thousands and thousands of viewers. Investors are making a beeline for the segment as well. And by some estimates, the global short drama market has moved from being about a $6.5 billion market to over $7.2 billion. And of course, the numbers are still growing. This market is expected to double by 2030. Now, why are we talking about this? Because some of the Indian companies, for instance, listed Z Entertainment, decided to enter this market with a small buyout. I think the startup is called Bullet, and they have decided to partner with it. So we have Karan Taurani, Executive Vice President at Elara Capital, as well as Raj Nayak, Founder and Managing Director at House of Cheer Networks, to help us make sense of this. Gentlemen, I'll start with an admission. I have never seen a micro drama. The reason I started looking at it is once we heard that Z is getting into this segment. So let's start with the broad thought here. Karan, I mean, is this a passing fad we're talking about, or is this becoming serious business?
Hi, Sylvie. Good morning. I think if you look at the content creation ecosystem, we have always seen innovation in some or the other manner historically in the last 20 years. We started off, with social media. We went on to YouTube. Then we went on to Reels, which was by social media. Then OTT content, web series content, binge watch, and now we are to this, kind of content which is micro drama. So I think it's much needed. Innovation on content is a good thing, and it's much needed. Second thing is that you have to look at the audience base. I think India as a market is quite favorable. We have got more than 400 million Gen Z users. Now, this user base demographic basically is open to trying out new things. And if you look at the acceptance, I think currently there is some bit of acceptance for the global micro dramas today in a market like India in the urban markets. How this scales up in terms of the non-metro markets, how the consumer base grows, that's something to be watched out for. But definitely innovation is needed, and Gen Z is willing to try this kind of thing.
No, absolutely. We're no denying that. There's no disagreement on that at all. But do you have any early numbers, Karan, in terms of how big is the size? I mean, if you look at overall OTT market in India, I don't know, I mean, micro drama would be what, 1% of it, 2-3%? Do you see it gaining serious potential?
Yes, so I think if you look at the India OTT market, we are SWOT market and AWOT market put together. We're at about $3 to $3.5 billion. And a large portion of this market is dominated by YouTube. YouTube has been the major aggregator. Now, the problem here is that if you look at these OTT platforms by broadcast OTT platforms, like, for example, Hotstar, the likes of Z5, the likes of Sony Live, these have been very small in terms of revenue contribution. They haven't been able to scale up beyond a point. And the problem for this is because large part of their consumption in the OTT platform would come from catch-up TV content. So it's need of the hour to innovate for this kind of content. Obviously, in terms of numbers, I won't have numbers in terms of how big this microdrama market would be because very small as of now. But yes, definitely, if these guys are able to execute well in terms of quality of content, if there is acceptance from the consumers, they can give a tough fight to someone like YouTube as well.
Okay, all right, got that, Karan. Well, let's get in Raj into the discussion as well. Hi, Raj, it's been a while since we spoke. I enjoyed your review you put out on Sitare Zameen Par over the weekend. So that was pretty good. I backed that as well. But that discussion for another time. You've seen everything, right? From the traditional daily programming to the rise of OTT. Will microdramas disrupt or coexist with the long-form OTT content in India? What are your thoughts?
I think it will coexist. I mean, disruption, everybody said when TV came and OTT came, TV is going to die. When radio came, people sang the same song. But the fact is, I think it will coexist. But what is important now is, just look at yourself. The amount of time you spend on your phone, right, is more than what you spend on television. People are consuming news on their phone today. And TikTok or Instagram is a great example of the number of hours people spend on scrolling for content. So microdramas, in a way, if it's done well, like some of the companies in China have done very well, as long as every minute or 2 minutes, whatever the content is, as long as there's a cliffhanger at the end of every episode, and it's seen more as a viral video rather than just a X episode, I think it can go on, and I think it will catch on. Because I look at people in Bombay sitting on trains, they will just keep consuming content, and content consumption is going to happen. We are a country with, I think Karan just gave some numbers. Gen Z itself is about 200 plus million or whatever it is, and there are more than 900 million handphones in this country. So I think it is here, it will grow. It's like in the FMCG business, what came as sachet. People started selling sachet shampoos. I think that's a similar kind of concept here. And monetization will be easier, in my opinion. It will be faster because you can price it as low as, say, 25 paise per episode, that kind of a thing. The payment gateway is going to be a challenge. As long as they fix that, I think content generation is not going to be such a big problem because most of the content it's a challenge in a way, but most of the content that's done at the moment, even in China, is based on AI. Okay, but but that over a period of time won't give you original content. That's a challenge that we will have. But if you can fix that, if you can address that, I think it's a huge market, very big market.
Wow, and we've come such a long way. Imagine the average time duration of a song in a Hindi movie would be, at least 2-3 minutes. From that time, we've come to this discussion of microdrama. So content is really changing. But gentlemen, let me ask you again, just to press that point on monetization, if we have any kind of proven track record or even some instances that we can draw from globally, whether this format is working business-wise in terms of generating slightly meaningful revenue? Raj, any ideas here?
I don't have exact numbers, but what I know is, look at it this way, right? When we did advertising, in a 30-second commercial, you told a story. Now visualize, in a 2-minute, you'll be able to tell a much better story. That's the way to look at it. And monetization, I think, will happen. It's easier to monetize only because your ticket price can be so small, because your content creation is going to be extremely cheap, because you're not going to do 5 or 10 episodes. You're going to do 100, 200 or 300 episodes. All you need is a one set and good story with a good plot. And every day you can shoot, in a matter of 15 days, you can shoot all the 100 episodes, and that's it. And then you just keep releasing them every day.
Interesting, Raj. So you have answered a few of our queries there. They can coexist, could be monetized, and pricing is going to be interesting as well. And we have a big Gen Z population as well. But before we wind down in the conversation, Karan, let me come across to you. How do you think platforms might approach monetization? What are your thoughts? Do you think it's going to be ad-driven, subscription-based, or do you think it'll be via branded content?
I think for a market like India, we will initially move the AWOD way, for this kind of content. We have clearly seen in the past as well, the way YouTube has scaled up. They obviously are large because of the AWOD. If you look at the content which is behind the paywall, is largely the premium nature of content. Now, this kind of content, probably is very low cost in nature. That's the good part. ROI in this content could be extremely attractive. So I think initial inroads will be via AWOD. Globally, there are more concepts and more models where this content is also seen as scale in terms of SWOT basis. Last but not the least, I think all these platforms need to get a very good technology over here, because a lot of your monetization through advertising will happen via AI. So they need to have a really sound technology-based system to really monetize this kind of content and build upon that.
Just clarifying, this medium has its own language. When you say AWOD and SWOT, it's basically an advertising-based model versus a subscription-based model, right, Karan?
Yes, absolutely. So initially, the scale will happen on advertising-based model.
On the advertising side. Got that. Thank you very much. Very, very interesting subject. And I think we'll probably have more conversations in this as the market evolves. So thanks very much for those interesting thoughts. Well, with that, we're completely out of time. So we're going to wrap up this edition of Bazaar. Thank you very much for being with us. Markets are in steady form. Chartbusters takes the action forward.